Hey there. You and I are about to crack the code on some serious investing wisdom today. Think of it as time travel, but for your portfolio.
I like that.
We're diving deep into Warren Buffett's 1993 letter to Berkshire Hathaway shareholders.
It's a classic for a reason.
Oh, definitely.
We're talking pure, uncut Buffett, his investment philosophy, his big wins, even a few head-scratchers.
Right.
And trust me, the lessons from 93 are surprisingly relevant today.
Right. It's like getting a peek inside the mind of one of the greatest investors of all time at a specific moment in history.
Totally.
Our mission is to extract those timeless insights from Buffett's letter and see how they apply to you and me right here, right now.
Exactly.
We're not just looking back, we're looking for those aha moments that can inform our investment decisions today.
I think there will be a few of those.
Oh, I think so too.
Yeah. Okay, so picture this. It's 1993.
Okay.
Nirvana's on the radio,
Mm-hmm.
and Buffett's dropping his annual letter on shareholders' desks.
Love it.
Right out the gate, he hits them with some impressive numbers.
Yeah, he does.
Per share book value is up 14.3%.
And he doesn't stop there.
No.
Buffett goes on to highlight that over the past 29 years, Berkshire Hathaway's book value has grown at a compounded annual rate of 23.3%.
Wow.
That's the kind of long-term track record that makes investors drool.
It's like the financial equivalent of finding the fountain of youth, right? But here's where it gets really interesting.
Okay.
Even with these crazy good numbers, Buffett's quick to point out that book value isn't the be-all and end-all.
It's true.
He's all about intrinsic value.
Mm-hmm.
What do you think he means by that?
He's basically saying, forget what the market's saying today. Okay.
Let's talk about what this company is really worth in the long run.
Interesting.
Book value is just a snapshot, an accounting measure.
Oh, okay.
Intrinsic value is about the future earning potential of the business.
So it's less about the sticker price and more about understanding the engine under the hood.
Precisely.
I like that.
Buffett's digging deeper, looking beyond the balance sheet to understand the real drivers of value creation.
Okay.
And that's a crucial lesson for any investor, no matter the size of their portfolio.
It's like the difference between buying a house based on a quick glance versus getting a thorough inspection and understanding its potential.
That's a great analogy.
Okay, so Buffett's emphasizing long-term thinking and intrinsic value, got it.
Yes.
But then he goes on this whole tangent about accounting anomalies, and frankly, it almost lost me. Help me out here. What's the key takeaway for everyday investors?
He's highlighting how the rules of accounting, even though they're supposed to be objective,
Right.
can sometimes obscure the true picture of a company's performance.
Yeah.
In 93, changes in generally accepted accounting principles, or GAAP, actually negatively impacted Berkshire's net worth.
Wait, so even though Berkshire was doing well, these accounting changes made them look worse on paper.
Exactly.
Wow.
And the changes were related to unrealized gains profits that hadn't actually been realized yet.
Okay.
Buffett's point is that investors need to understand the nuances behind the numbers.
Yeah.
Don't just blindly trust the headlines.
So it's like reading the fine print before you sign a contract.
Yes.
Look beyond the surface level to understand what those numbers really represent.
Absolutely. It's about developing a critical eye.
Mm.
Sometimes a company's reported earnings might look great,
Right?
but there could be underlying factors that tell a different story.
Yeah.
And conversely, sometimes a company might appear to be struggling on paper, when in reality, they're making smart long-term investments.
So we've got to be more like financial detectives, huh?
A little bit.
Digging deeper to uncover the real story.
That's the idea.
Okay, speaking of stories, Buffett tells this incredible tale about Coca-Cola stock performance that I think perfectly illustrates his long-term mindset.
That's a good one.
It's like a masterclass in patience and tuning out the noise.
It is.
Yeah.
He talks about how Coke's stock, even after being a phenomenal performer for decades,
Yeah.
experienced periods of wild volatility.
Really?
Like that 50% drop in the 1920s after its IPO.
Oh, wow.
Can you imagine buying Coke back then and seeing your investment get cut in half?
Honestly, I probably would have panicked and sold. What separates investors like Buffett from the rest of us?
He understood that short-term market fluctuations are meaningless compared to a company's long-term intrinsic value.
Mm-hmm.
He held on or reinvested the dividends,
Right.
and by 1993, that single share of Coke was worth over $2 million.
Okay, now that's what I call riding out the storm.
It is.
But it requires a certain level of, I don't know, almost Zen-like calm, doesn't it?
It does.
To see your investment get cut in half and not panic.
That's the essence of Buffett's approach.
Mm-hmm.
He's playing the long game.
Okay.
focusing on the fundamentals of the business, not the daily whims of the market.
It's like he's saying, don't just watch the scoreboard, focus on playing the game.
I like that.
Which brings us to what I think is one of the most intriguing parts of this letter, the Dexter Shoe acquisition.
Okay.
I mean, when I think of Buffett, I think of iconic brands, not shoes.
Right.
What was the play here?
It might seem like an odd choice at first glance, right?
It is.
But this is pure Buffett finding value where others might overlook it.
Okay.
Dexter, at its core, was a well-managed company with a strong competitive advantage in a tough industry.
So it's not about chasing the flashiest trends. It's about identifying those under-the-radar opportunities.
Exactly.
Okay.
Buffett saw something special in Dexter's management team, particularly its CEO, Harold Alfond.
Interesting.
He admired their ability to run a tight ship and consistently deliver profits, even when the U.S. shoe industry was getting hammered by imports.
He was basically betting on the jockey, not just the horse.
Exactly. And that's a key takeaway here.
What's that?
Buffett emphasizes the importance of strong, capable leadership.
Right.
He's looking for companies with a clear vision and the ability to execute, even in the face of challenges.
Which is a good reminder that investing isn't just about spreadsheets and financial ratios, right?
Yeah, it's not.
It's about understanding the human element, the people, and the decisions that drive a company's success.
Absolutely.
Yeah.
And the Dexter Shoe acquisition highlights another important aspect of Buffett's investment philosophy.
What's that?
His no strategic plan.
What?
He doesn't limit himself to specific industries or follow a rigid playbook.
Oh.
He seizes opportunities when he sees them.
So it's less about sticking to a predetermined shopping list and more about being adaptable, keeping your eyes open for those hidden gems no matter where they might be.
Precisely. He's looking for businesses with strong fundamentals and trustworthy leaders, regardless of industry or perceived hotness.
Okay.
It's a lesson in being both disciplined and opportunistic, a powerful combination in the world of investing.
So we've got long-term thinking, intrinsic value, digging deeper into the numbers, the importance of strong management, and now this idea of being adaptable and seizing opportunities.
Right.
These are all starting to feel like pieces of the Buffett puzzle, wouldn't you say?
Absolutely.
Yeah.
And the 1993 letter gives us an even deeper look into how he approaches corporate governance,
Okay.
a topic that's just as relevant today as it was back then.
Definitely.
But before we get into that, I think it's important to understand Buffett's views on philanthropy.
Okay.
He has a unique take on it, and it ties directly into his beliefs about ownership and shareholder value.
All right, so let's switch gears a bit and talk about how Buffett gives back.
Okay.
What's so unique about his approach to philanthropy?
He calls it shareholder-designated contributions.
Shareholder what now?
Shareholder-designated contributions.
Okay.
Instead of Berkshire Hathaway deciding as a corporation where to donate a big chunk of money, he empowers the shareholders to direct a portion of those charitable funds.
Wait, really? So it's like each shareholder gets to be a mini philanthropist deciding where a slice of Berkshire's giving goes.
That's exactly right.
That's wild.
It's very unique.
And you never heard of another company doing that.
It's incredibly rare.
Wow.
And it goes back to Buffett's core belief that a company's money ultimately belongs to its owners, the shareholders.
He even questions why CEOs should get to play Santa Claus with shareholder money when they would never dream of doing the same with their own personal funds.
It's like he's shining a light on this weird quirk of corporate philanthropy, that it's often the CEO's pet projects that get funded, not necessarily what aligns with the broader shareholder base.
Exactly.
Yeah.
And the beauty of Buffett's approach is that it provides a fascinating glimpse into what matters to the people who own a piece of Berkshire Hathaway.
Okay.
For example, he points out that a significant portion of the donations went to religious institutions, churches, and synagogues.
That's interesting because you don't typically see those organizations at the top of the list for corporate giving programs.
Right.
It's like he's tapped into a whole other level of charitable giving that's often overlooked.
He has.
And what's even more fascinating is that Buffett doesn't shy away from the fact that these choices sometimes reflect conflicting viewpoints.
Oh, really?
He mentions that some shareholders directed their donations to pro-choice organizations, while others chose groups opposed to abortion.
It's a good reminder that Berkshire Hathaway is a company made up of individuals with their own values and priorities.
Right.
And that's okay.
Yeah.
Buffett's not trying to impose a top-down ideology.
No.
He's embracing the diversity of thought within Berkshire's shareholder base?
Precisely.
Okay.
And despite this unconventional approach, he emphasizes that it's surprisingly efficient.
Okay.
He proudly points out that Berkshire's total charitable giving is actually larger than the company's entire corporate overhead.
Wait, he's saying they give away more money than it costs to run the whole operation?
That's what he's saying.
Talk about putting your money where your mouth is. Okay, so we've covered Buffett's approach to long-term investing, finding value, the importance of good management, adaptability, and now this incredibly unique philosophy on philanthropy.
Right.
But there's still a lot more to unpack in this letter, right? Like this concept of look-through earnings.
Okay.
I gotta be honest, that one's always confused me a bit.
I hear you.
Yeah.
It can seem a bit technical at first, but it's essential for understanding how Buffett evaluates Berkshire's performance, especially given its large ownership stakes in other publicly traded companies.
Okay, so walk me through it.
Go on.
What is look-through earnings and why does it matter?
Imagine you own a piece of an apple pie company.
Okay.
Under traditional accounting rules,
Yeah.
you only get to count the slices of pie dividends you receive as your income.
Mm-hmm.
But what about all the apples, sugar, and dough retained earnings inside the company that's contributing to its growth and the value of your ownership?
Yeah, okay.
That's essentially what look-through earnings takes into account.
Okay, that makes a lot more sense now. So it's like instead of just focusing on the dividends being paid out, you're considering the earnings power of the entire pie, even the parts that haven't been sliced up yet.
Exactly.
Okay.
Buffett argues that this gives a much more accurate picture of Berkshire's true earnings power, especially since it owns large chunks of companies like Coke, Gillette, and Capital Cities.
Right.
Those undistributed earnings are like a powerful engine driving growth and compounding value over time.
And speaking of compounding, Buffett ties this concept of look-through earnings directly back to his love of long-term investing. He uses the example of selling a portion of Berkshire's Cap City shares for a profit that dwarfed the dividends they received over the years.
It's a perfect example of how compounding, even when it's not immediately reflected in reported earnings, can lead to incredible returns over time.
It's like he's saying, be patient, let those earnings compound, and watch your investment grow like a snowball rolling downhill.
Yeah,
I'm starting to sense a theme here.
definitely.
Okay, so before we move on to the next nugget of wisdom from this gold mine of a letter, can we just take a moment to appreciate how Buffett seamlessly weaves together these complex financial concepts with these down-to-earth examples?
It's really incredible.
It's brilliant.
I agree. He's a master storyteller, and it's that ability to take complex ideas and make them relatable that makes his writing so engaging and insightful. Okay, so are you ready to dive into the world of insurance?
Sure.
Because that's where Buffett takes us next.
All right, let's do it.
Okay,
But be warned, I'm not exactly an insurance expert.
that's all right.
You might have to break it down for me.
No problem.
Okay,
That's what we're here for.
thanks.
Buffett spends a considerable amount of time in this letter discussing the insurance industry, particularly the concept of float and Berkshire's position in the supercap market.
Okay, so let's start with float.
Okay.
I've heard Buffett talk about it before, but it's always gone right over my head.
Sure.
Can you give me the ELI5 version?
Imagine you run a lemonade stand right,
Okay.
and you decide to offer your customers a new deal. They could pay you $1 now for a glass of lemonade that they can redeem anytime in the next year.
Okay. I like where this is going.
You collect a whole bunch of dollars up front, but you haven't actually had to spend any of it yet because those lemon-tea-thirsty customers haven't come back to redeem their drinks.
Right.
That cash you're holding that's kind of like float.
Okay.
It's money that you get to hold and potentially invest before you actually have to pay it out.
Okay, that makes so much more sense. So insurance companies are basically running giant lemonade stands, collecting premiums upfront and investing that money before they have to pay out claims.
Exactly.
Wow.
And as you can imagine, the bigger the lemonade stand, the larger the float.
Okay.
And Berkshire Hathaway, through its various insurance subsidiaries, has a lot of float.
Wow.
In fact, Buffett calls it the most important factor in Berkshire's superior performance.
Wow. So it's not just about picking winning stocks, it's about leveraging this concept of float to amplify their returns.
Yeah, brilliant. But it's not without risks, right?
Exactly.
All
And
right.
Buffett addresses that head on in the letter, particularly concerning Berkshire's exposure to what he calls supercats, catastrophic events like hurricanes and earthquakes.
Yeah, those have a way of messing up even the best laid financial plans.
It's true.
What's Buffett's take on navigating those mega risks?
He compares it to playing roulette.
Okay,
You might win a bunch of times betting against a rare event like landing on zero,
right.
but eventually your luck's going to run out.
Yeah.
And when it does with the supercat, the losses can be enormous.
So it's like walking a tightrope, right? Trying to balance the potential rewards of this float with the inherent risk that comes with insuring against these mega disasters.
Exactly. And what's fascinating is that Buffett acknowledges they got lucky in '93. No major hurricanes slammed into the U.S., which meant their super cat portfolio had a good year.
Right.
But he's also clear that this isn't a sustainable strategy.
Okay.
It's not about dodging hurricanes. It's about having the financial strength to withstand them when they inevitably hit.
Which, knowing Buffett, they probably did.
Right.
He always seems to be a few steps ahead.
Yeah.
Okay, so before we wrap up our deep dive into this treasure trove of a letter,
Okay.
I want to go back to something you mentioned earlier, corporate governance.
Okay, sure.
Why does this matter so much to Buffett?
Remember how we talked about Buffett looking for companies with strong management teams he can trust?
Yeah.
Well, corporate governance is all about ensuring that those teams are accountable, transparent, and acting in the best interest of the owners, the shareholders.
So it's like the guardrails on a winding mountain road.
Yes.
Making sure the company doesn't veer off course.
Exactly.
Yeah.
And Buffett gets surprisingly candid in this letter about his own mortality and what that means for the future of Berkshire Hathaway.
Wow.
He lays out 3 distinct models of corporate governance
Okay.
and explains how they play out in the real world.
All right. Let's break those down.
Okay.
What are the different models, and which one does Buffett think is the gold standard?
He starts with the most common scenario, a company with no controlling shareholder. Think of a typical large public company with shares spread among thousands, even millions of investors.
Right.
In this model, Buffett argues that the board of directors needs to act as if they were a single rational owner,
Okay.
making decisions for the long-term benefit of all shareholders.
That makes sense.
Yeah, but it also seems like it could easily devolve into a free-for-all if the board isn't aligned on a common vision.
Exactly. That's why Buffett stresses the need for independent directors who aren't afraid to hold management accountable
Okay.
and are truly focused on building long-term value.
So not just checking boxes, but finding people who truly understand the business and have skin in the game.
Precisely.
Yeah.
Now, the second model Buffett describes is particularly interesting because it's the one that Berkshire Hathaway was operating under in 1993.
Okay.
The case where the controlling owner is also the manager.
Which is classic Buffett, right?
Yeah.
He's been at the helm of Berkshire for decades.
Yeah.
But he also seems aware that this model has its limitations.
He does.
Yeah.
He openly acknowledges that in these situations, the board often has less power to influence decision-making.
Makes sense.
The owner-manager essentially calls the shots.
Which makes sense if you built the company from the ground up. It's hard to let go of the reins entirely.
Right.
But Buffett doesn't seem to think that's an excuse for poor governance.
Not at all. He still emphasizes the importance of having strong, independent voices on the board,
Okay.
even if the owner-manager has the final say.
So it's less about telling the owner what to do and more about providing guidance and constructive criticism.
Exactly.
Okay.
He stresses that directors have a responsibility to voice their concerns, even if it means disagreeing with a powerful owner-manager.
Wow.
He even goes so far as to say they should be willing to resign in protest if their concerns are ignored.
That's a powerful message about integrity and putting shareholders first.
It's
So if Model 2 is about a strong owner-manager with a supportive but vocal board,
right.
what's Model 3?
Model 3 is the one Buffett believes is the ideal.
Okay.
And it's where a controlling owner is not involved in the day-to-day management of the business.
Interesting.
He uses companies like Hershey Foods and Dow Jones as examples.
So in this model, the owner is more like a captain setting the course but trusting a skilled crew to steer the ship.
Exactly.
I like that.
And Buffett argues that this structure gives the board more autonomy
Okay.
and a more direct line to the owner if changes in management are needed.
Right.
There's no CEO to convince, no complex bureaucracy to navigate.
And this is crucial for ensuring that the company is being run effectively over the long term, even when the founder is no longer at the helm,
Right.
which is especially relevant for Berkshire Hathaway, right?
Yeah.
Buffett can't be at the helm forever.
Exactly. And he addresses this head on in the letter, assuring shareholders that Berkshire has a plan for this transition.
You okay?
He reminds them that his wife Susie joined the board a few years prior.
Hmm.
And in '93, his son Howard also came on board.
Okay.
They won't be managing the company, he clarifies,
Right.
but they'll represent the controlling interest after he's gone.
That's got to be reassuring for shareholders, knowing that Buffett's legacy is in capable hands and that there's a plan in place for the future.
Absolutely. And it highlights another key point. Succession planning isn't just about finding a replacement CEO.
Right.
It's about ensuring continuity of vision values and long-term thinking.
Wow. We've covered so much ground today.
We have
From accounting anomalies to shoe acquisitions, from look-through earnings to super cats, from corporate governance to the importance of strong boards and succession planning.
That's a lot.
If we were to distill it all down, what are the key takeaways from Buffett's 1993 letter that listeners should carry with them?
I think it boils down to a few core principles.
Okay.
First, think long-term.
Okay.
Tune out the daily noise of the market and focus on finding great businesses with sustainable competitive advantages that you can hold for years, even decades.
Mm-hmm.
Second, understand the difference between price and value.
Okay.
Don't just chase the latest hot stock. Dig deeper, understand the business, and be willing to be patient.
Right.
And finally, remember that investing is about more than just numbers.
Okay.
It's about people. Look for companies with strong leadership, a clear vision, and a commitment to ethical and transparent governance.
It's like Buffett's sharing his secret recipe for investing success. But instead of flour and sugar, it's long-term thinking value investing and finding companies with integrity and strong leadership.
Exactly. And like any good recipe, the real magic happens when you take these ingredients and apply them to your own unique situation.
So true. Well, on that note, we've reached the end of our deep dive.
Well, this is great.
But before we go, I want to leave our listeners with a final thought, a bit of a challenge inspired by something Buffett himself says in the letter.
Okay.
He admits that even he's wary of making predictions, even in industries he knows well.
Right.
So the question for our listeners is this. If one of the greatest investors of all time is hesitant to predict the future, how can we as individuals apply his principles of long-term thinking and value investing in a world that seems increasingly uncertain and complex?
That's the million-dollar question, and one that each listener will have to answer for themselves.
Indeed. But hopefully our deep dive into Buffett's wisdom has provided some valuable insights and a framework for navigating the ever-changing world of investing.
Absolutely. And remember, the journey of investing, much like the journey of learning, is ongoing.
Well said. Thank you for joining us on this deep dive.
Yeah, thanks for having me.
Until next time.